All right. Good morning, everybody. It's Friday, the day we've been waiting for all week. It's finally here. The big jobs data, as opposed to all the other minor jobs data that we've had this week. This is the one that's going to stick. It's going to count. It's very likely going to impact us all the way into the next FOMC meeting. So we have a trade setting up today that I really like. Normally, this is a trade that I talk about on CPI days, possibly PPI days, but non-farm payrolls, which is what we have today, is the other place where we get this opportunity. Normally, I crawl through the charts and go back in the past trying to find these examples, but I've got them saved. This is a CPI print. Starts at 8:30 when the CPI data comes out. You get a single drive in one direction. Bases across the top or bottom, and then it spends the rest of the day trying to get back to that spot. I call this a liquidity gap, and I've seen it called other things. But for me, it's just a liquidity gap. It's not a gap in candles. I've had people say, I don't get it. There's a candle there. There's no gap. It's a liquidity gap. Think of it like, a vacuum. We're leaving an empty space behind through liquidity, and price is trying to come back and get it reset. And there's a couple of odd quirks that go with this. When it gets down there and it tags, and we get this first rebound, it seems like a lot of times we also get the same size as an overshoot. So this is one example. Here's another example, and this is what we don't want, right? If the data comes out today and it sends price jumping in both directions and we just get this really big wide candle with wicks on each end and it closes really close to where it started, then the entire thing is null and void. We just don't have it. So, a trade setup is only good when it actually gives you the full setup with all the parts and pieces. And if you don't have all those parts and pieces, then you don't have the trade. So we won't try to do it. This is the June CPI. 8:30 came, we got the data, it spiked all over the place. We basically closed right where we started and no trade. So here's another example, CPI data, where it didn't come down and close the gap. So while we are expecting the gap to get closed, and you can see it made a solid attempt to do that, it just never got it closed. So when it comes to strategies, I always like to point out the way it's supposed to look, and then point out examples and errors of how it should not look. One of the things that you'll find when you start building your own strategies is, they don't always work, right? The faster you can tell that it's unraveling and it's beginning to do something that it's not supposed to do, you can GTFO and just cut it as soon as you can, right? Which is, to me, is much better than letting it play out and taking a full stop out of the trade, because I really would just rather not do that. So this is another example of failure. It just didn't play out. Like all strategies, it doesn't always work. So an example of what we don't want, big wide candle in each direction, it's not what we want. And these liquidity gaps, they don't have to happen just at 8:30, and they don't have to happen just because of a economic event. We see it at FOMC on Wednesdays at 2 and then again at 2:30 during that whole thing. But it can also happen during the day if some shocking news comes out. Really, the main thing is traders with unfinished business and a market wanting to go back and finish that business. So you can see the move intraday too. That just requires more, right? More analysis, more perspective. So here's another example where it did work. Single print, one direction. It spent the rest of the morning working its way back down. to that gap close, and then the overshoot. We have this on deck today, and it's something that I've been looking forward to for a little while now, because we don't get very many of these every month, but we do get a few, or at least we get the opportunity for a few. And, that's the way it is with some strategies. I think you'll find that some of your best strategies, your most profitable, high impact strategies, they just don't have a lot of occurrences, a lot of opportunities to use them. This is one of those. I really love this strategy when it presents. We just don't get a lot of opportunities. So we are green on the screen around the world. Hong Kong leading the way, up 1.5%. Behind that, Europe's doing fine. Japan at 0.5%. And then all of our markets stacked, with the Russell up the most at almost 0.25%, and the S&P 500 up the least at just 12%, or 0.1%, really just kind of rounded a little bit. So far, so good. How the data is going to affect us today, this very likely is going to be good news is bad, bad news is good kind of a scenario. The Fed has been raising rates at a historic pace. And one of the things that they look for to see if they're accomplishing their goal is unemployment numbers. They're looking for mildly restrictive territory. To find that, they have to go slightly beyond the neutral rate, which is some mythical, hypothetical thing that they can't quite put their finger on. So if you don't know where neutral is, how do you know you've raised beyond that neutral spot to a mildly restrictive territory? That's the rub, right? That's the trick. And that's what they're trying to see. So if we get a really hot jobs data print, and it shows that, unemployment is down beyond and below the consensus estimate of what it should be, that would be really good, right? It shows that, a lot of people are at work. There's not a really high unemployment. That's really good numbers. It's good news. But it would imply that everything that the Fed has been doing isn't working. And they want to see signs that all of these rate hikes and all of the damage that they've done at least has begun to accomplish the goal that they set out to do. So if we get that hot print, the market's not going to like it. It's very likely going to send us to the downside. And if we do get an unemployment number that's kind of high, and it shows that the Fed is accomplishing their goals and that more people are out of work, that bad news, which would be bad economically, does show that the Fed is accomplishing their goals, at least in a minor way. And the market's going to like that. One of the reasons the market is paying particular attention to this is because they really want to see the Fed start to cut. It's what sends the market into a tizzy when we just had the FOMC and Powell said that things looked so good, they didn't see a recession in the forecast for at least 2 years. What the market heard in that sentence is, we're not going to cut for at least 2 years. And you see the results since the last FOMC. We've just been going down and down and been getting these sell-offs, and we're getting worked through a capital rotation, and there you go, right? So the market wants anything at all that might give a wink and a nod that the Fed is going to have to cut sooner than 2 years. Bad jobs data would give them that wink and nod. So if we get bad news today on the job numbers, the market's very likely going to shoot to the upside. And if the unemployment comes in the other way, then we're very likely going to head to the downside. It is the biggest thing on the table today, but it's not the only thing on the table today. Consumer credit at 3 o'clock. Although I got to say, the afternoons on a Friday, it's not exactly the spot where, I like to go out and build new trades anyways. But still, got to keep your eye on the clock and not get run over by different economic events. We're looking at FX Street here, which is a really great place to go if you're not sure of the different economic events that we get on a day-to-day basis. Which ones should you be worried about? Which ones maybe, you don't need to be too concerned about? Because this one will rank them for you by their order of magnitude, what they have historically done to the market. Are they volatility inducing, or does the market really just kind of shrug that data off? And then they just use these different levels between mild, medium, and hot, right? Like Taco Bell sauce or something. We do have Fed speakers today as well. Waller's going to be out chipping his teeth. And we get a little bit of data out of Japan, which somebody sent me a link the other day. Appreciate it, by the way. There's the world that we live in, there's just a fire hose of news, right? It never stops, and you can wade through it all day long and still not get through all of the data that's coming in. The link that someone sent me the other day was a Bloomberg article where they discussed a deep dive into that move in US dollar Japan that happened this week. Most of us had assumed that the Bank of Japan had intervened, but according to this deep dive, they had not yet intervened. That move that we saw in US dollar Japan was not a Bank of Japan intervention. It could explain why we didn't see some of the things that we should have seen, and maybe why it didn't stick. So something to consider. Now, when they interviewed Bank of Japan on it, they always play coy, and they're like, "Oh, it wasn't us. I don't know what you're talking about." But that's the same answer that they give when it really is them. So, that part of it, I really don't care about in the story. But the rest of it was just like with our government. The government puts out their data. Every nation has a set of books. Those books are public. We can see where the money's being spent, except for, the wink, wink, behind the scenes, dirty money or dark money. But for the most part, the public money in the public book is something that we can track. And if Bank of Japan had intervened, that purse would have changed size, just like ours would if the Fed goes out, and starts dropping money all over the place, say like during COVID with the helicopter money. It's something that can be tracked. So from the looks of it, we still haven't seen an intervention move on US dollar Japan yet. If you're interested in that article, just DM me later. I'll shoot it to you. You will need an account at Bloomberg to read it, but hey, it's like $4 a month. This is the move index. And really, just like you have the VIX, the VIX, which is looking at the S&P 500, and you've got VIX for the NASDAQ, VIX for the Russell, VIX for gold, for oil. Well, this is like VIX for bonds, right? It's measuring the bond market volatility. Things are getting a little wild out there. But as funny as it sounds, or as much as you would believe with the moves that we've seen in the last week or so in the bond market, the volatility isn't nearly as bad as it was back in March of just this year. So we are at some pretty high levels. Some of the concern is how fast we got to that level, right? It's not always the fact that we're at a certain price in anything. It's how fast we got there. Those fast, sudden moves is generally what freaks people out and or what breaks things. So we have had some fast moves in bond volatility this week, and I am on a weekly chart. But I've got some levels marked out, like the bank crisis of this year. It's the 2023 when they went in and bailed out the banks. That subtle little assist. The 2009 global financial panic, the 07-08 financial crisis, and the COVID situation. So, we're not at those levels yet, but it's worth keeping your eye on in the bonds market, right? Especially if you're thinking, oh, we're at these deep lows. Surely now is the time to buy bonds. No, you don't want to go bottom fishing in the bonds market. All right, US dollar Japan. We're still holding these highs, and looking at this on a weekly chart, this does not look bearish, right? Not at all. Looking at their 10-year, we're above 0.8 now. The line in the sand here is 1.0, and I don't think they're going to let it get that close, but that's the level. We can see back in 2022 when they were still running their yield control at 0.25%, they did a pretty decent job of keeping it at that 0.25%, right? It would get a little high now and then, and it dropped down a little low, but for the most part, it was holding that 25%. Then when it got out of control, they said, okay, well, we're willing to allow it at 0.5%. Then we had the situation with the banks back in March. This faded down, got back up into that half, and now getting a little out of control. Continues. That doesn't look bearish at all. So a little bit of a heads up there. That ties right in with the idea of, do we think there's going to be an intervention? Yep, but the answer is when. So if they didn't fire their first shot yet, that means, let's say it another way. After we thought they had intervened, we thought that it would also now take a couple of weeks before they could intervene again. The way it played out last time, they intervened in September, they came back again and gave it another shot in October. Well, they haven't intervened yet at all. So we're not sitting weeks waiting for that next intervention. They can still do it at any time. And it seems like they like Fridays. So it's Friday, and we have this really big economic data point that's coming out today. And if we start heading to the downside because of this bad data, one of the things that they can do to play save a hoe, if you've ever heard of the plunge protection team and coming in and save the markets, all they got to do is start talking about policy, right? The Fed can come out, start chipping their teeth and just talking about looser policy, and the market can turn around based on that kind of language, or some kind of intervention in the FX market somewhere around the world that would turn this market around. Should we start selling off hard to the downside with bad jobs data today? So if we do start to make that move to the downside and it's looking really nasty and it just feels like it's one of those days we want to short it all the way into the ground, watch the clock and be ready for that flip to come in. It won't be one of those days where we just run it to the downside all the way down until 3:30 before we flip it back up again and into the close. I think it'd be violent and fast, and that they'll come in and flip that sucker over. The volume is really light this morning, not too light. It's not below our gauge or our levels that we keep track of, but it is below 100 at 7:30. They are hedged and are continuing to hedge. That thing is crept up a little bit more. So as you would expect, you know, they're hedging in the front end, which is why we have the market maker move. And the volume is light because they're waiting on the data to come out. Makes perfect sense to me. They don't want to get run over, right? I don't blame them. I wouldn't want to get run over with that size either. So looking at it on the weekly, we did make contact with that 50 period moving average, and we're back above it for now. But if the data comes through today that's bad, or that the market doesn't like and sells off, I think we'll get back below that 50. So that's going to be one of the targets to the downside is 42.62. If we do continue moving to the upside, 43.77 is the 20 period moving average. 20 period weekly moving average. And looking at it on the daily, we've got the 10 period and the 200 right on top of each other. So that's going to be, you know, a little bit of a struggle to get through that zone. 43.15. And we can see 4,300 here. I'm going to zoom in just a little bit. 4,300's been an area, a struggle of fight. In these last 3 days, every time we've gotten into that 4,300, we sold back out of it. And every time we got around that 42.60, we've bought back up out of it. One of the candles of concern is this really big candle print from the 3rd. The 50% line in the sand, 42.93.5. Remember, for this to be a part of the recovery, it has to get back above that 50%. Otherwise, you're still just looking at a market that is trending to the downside. It has a pullback. For trending to the downside and have a pullback, trending to the downside and have a pullback. This is part of that pullback that we're looking at right now. And that's a little bit of a tell on whether or not it can get through the 50% point. Close above it on a daily, that'd be a really good start. I added the spot gamma level today just to kind of bring in some of their levels, because we've got the potential to make some sweeping moves. The put wall is down here near the ADR low. It's actually below the ADR low. 42.35 is the ADR, and the put wall is below that. 42.32, which is the cog line. Zero gamma's 43.62. Got the volatility trigger right close to the ADR full to the upside. Laying on top of the cog line, 43.32. Before I started using spot gamma, those 32 levels as a cog line is something that I focused on a lot. But the only thing I had to go with is that they were cog lines in lower areas back when, you know, the ES was sitting at 2,300 and 3,300, not 4,300. So these cog lines have been around for a long time, and those 32s are a number that I use just as a default, even without actually validating them as a cog line, because the amount of work required to validate a cog line is just nuts. So it is nice to see that the spot gamma levels very, very often line right up with those cog lines, the 32s and the 11s. Like I said before, when you get the same answer from multiple sources, you avoid multicollinearity or the echo chamber. So if we can get 0 gamma 4362 and then the call wall at 4482, I know that feels like a long ways off, but the 21-day average daily range, or ADR, is 1.2%. Rather than using percentages, let's just use some dollar values. And we'll round down $51.50 for the 21-day ADR. So we could move $51 higher, we could move $51 lower, or from our highest to our lowest point through the day, we could move a total of $51. Okay, I mean, that's how the ADR works. Now add to that the market maker move, which says that we could move an additional $32. So we take 50, add 30, now you've got an $80 move, add the other $3 into that, it's an $83 move, put the change on there, you're looking at 84 and change. We'll just round it to a nice easy $80. It's an $80 move. Well, we know where the ADR line stops. It's this yellow line here. So from that, we'll just put on $32 more or 0.76%. And that's what we get all the way up to the 20-day moving average, 43.74, and right underneath the previous week's high. This is a very large market maker move. No, we're in an entirely different conversation now. The whole thing about US dollar Japan, that was all by itself. This move here is based solely on today's market maker move and the ADR levels. And we have a high market maker move because we have an economic event on deck, the non-farm payrolls. It'd be like having CPI day, PPI day, some other really big event day. In the pre-market, if there's an economic event on deck, like we have one today at 8:30, if the market is worried about it, they'll hedge. Their hedging causes this market maker move to show up, and we use that as a part of the projection. A market maker move isn't telling us that we're going to move that far, just that we have the capacity to move that far, because every market has a measured move, how far it should move on a day-to-day basis or on whatever candle you're on. If you're on a 5-minute, we know how far a 5-minute candle should move. If you're on a 1-minute, we know how far that should move. Every market's got a measured move. In times of heightened volatility, how far a market could move while still being considered normal is represented between the market maker move and its average move. This level that I just marked out is the addition of the market maker move to the ADR. So far, we're just talking about a normal move that we could go to 43.70 today, and it wouldn't even be considered a big move. That would just be considered another day, you know, like whatever, that's just another day, like going to the fridge to get a Pepsi. We're not talking extreme yet. And we're talking by the end of the day, right? This isn't like next week's projections. From our current location at 4,300, I'll just round it a little bit. we could easily move to 43.74, and the market wouldn't even consider that an outlier. Which means if we do start to move greater than what is projected, which happens all the time, right? Markets break their expected move range all the time, that we could take this projection or the range that I've given and double it. So we would add another $80 to the move, going from 43.70 to 46. No, 43.70, take it up, that's 44.50, excuse me, not 46. So in an outlier move, we could go to 44.50, and it would only be considered mildly outlier. To the downside, we could go down to 4,200 today, and that would not be considered an outsized move. So these are not the extremes that I'm giving you. These are just the normal projections of what it could do. It doesn't have to do any of that. And I'll even add to this, the more impactful that we think an event is going to be, like today's a biggie. Oh boy, today's a biggie. One, we know it's a biggie because the market maker move is so big. But it's just a really important data point, and the market is going to react to it. So they are in here hedging like crazy. But here's the rub, and this is something I didn't catch when I was newer to trading. If they think it's going to be a big move, they get scared and they go in and they hedge the hell out of everything that they're holding. Well, what makes a market move? When people are caught off sides and they're scared and dumping something, or they're caught off sides and FOMO and they're buying something. But when you've hedged yourself to the eyeballs, you don't have to sell anything and you don't have to buy anything to cover. So while we have the capacity today to make a really big move, what I found is they will hedge themselves so much that the market makes a big violent move in each direction and comes back to settle basically right where it was to begin with. And that we don't end up with one of those big massive moves. And I say this because I know traders who went out of the money in the SPX heavy on a CPI day or a non-farm payrolls day because they had heard from everybody under the sun that, oh my gosh, today is going to be a biggie. And it was a dud. And it wrecked their accounts. So those levels that I gave are what we could move today without being considered an outlier move. But it doesn't have to do that at all. This cone is a representation of an expected move. It uses volatility. And it gives us that projection over 100 days. Price will stay inside of this cone with a 68% accuracy, basically a 1 standard deviation. So we would break out of this cone about 30% of the time. Otherwise, 70% of the time, we're going to stay in it. That's the 1 standard deviation. And the projection for this cone came from this, from implied volatility. Right now, we have a volatility of 0.17. That says the ES can move 17% higher or 17% lower in the next year. Well, okay. I mean, I guess that's useful, but damn, a year? I need something a little better than that, right? But this is a daily chart, and that's implied vol, and that does the whole year. We want something a little more useful. Yeah, that's a good word, useful. So go into the options market, and instead of the entire year, you have volatility right here on the side. And you have plus and minus ranges for whatever time period you're looking at, 5 days, 4 days, today. So this is a 1 standard deviation plus or minus. We could move $55 higher, or we could move $55 lower. Put those two numbers together, that's a $110 range from the highest to the lowest point, and it still wouldn't be an outlier. But there's the market maker move, which right now has increased to almost $33. We add that number to that number. So now instead of $55 higher or lower, it's $88 higher or lower. Now you're looking at what, 170 something combined from the highest point to its lowest. You see how these numbers, it's just math. So we get to keep the emotions out of it. We get to keep the fear and greed out of it. How far could we go today and still not be considered an outlier move? We just look at the numbers, look at the math. It's pretty cool, by the way. I'm a nerd, so I think it's cool anyways. And none of this has anything to do with JP Morgan. Has nothing to do with the JPY, US dollar JPY pair. It has nothing at all to do with the currency discussion. This is its own situation. So the reason I started with this, though, is when we were falling the other day, the consensus was we were going to fall really far, really bad, unless there was some intervention somewhere. And on that day, US dollar Japan had that massive move. And so we all thought, oh, wow, there was the intervention. But it didn't really stop things. We just kept right on falling anyways. And the idea at the time was, well, maybe their intervention really sucked and they're going to have to come in and do it again. Well, it turns out they didn't do intervention. This was something else. So that means they can still do intervention. We don't need them to wait a couple of weeks, or we don't have to assume that they can't intervene for a couple of weeks. They can absolutely intervene today. If the market starts a deep and controlled move to the downside, or an uncontrolled move, really is the what we're looking for. If the market really starts to sell off hard and fast to the downside, and there's nothing likely to slow it down except intervention, Bank of Japan has not yet intervened and can be the one who intervenes today. Keep in mind, there's been a lot of intervention over the last week. Taiwan did it, Mexico did it, I think Germany, but don't hold me that. I'm not 100% on Germany, but there's been a lot of intervention in the last week. We had assumed or believed that Bank of Japan had already done it as well, but they have not. So who's going to play save-a-ho today if this market's dropping like a brick in water? Japan. So what we would want to do is, if this data point comes out and the S&P drops below, say, 4150, maybe just 4200, we want to be watching the US dollar Japan really close. And we're looking for signs that it does something like this. I'm on a 15-minute chart just from the day that it happened this week. It's pretty unmistakable what it's going to look like. It's going to look a lot like that, right? Like a flash crash in US dollar Japan. And you should see an immediate reaction in the ES and the NASDAQ and the dollar and the 10-year across the board in everything. It won't be subtle. It will be shockingly, obviously fast. If you go back to October of last year, you'll see a representation of that same thing, right? I believe it was Friday, October 21st. Sounds right. Something close to that. So that's what's on deck today. Just keep in mind, it doesn't owe us a big move, right? Markets have a range that they're supposed to stay in with a 70% accuracy. That's the 1 standard deviation. We can easily break that and make a 2 standard deviation, a 3. Heck, we've got history where we've moved 5, 6, and 7 standard deviations, right? Those are outlier events. The thing is, we're so hedged today, according to the market maker move, that it's hard to believe anybody's going to be caught flat-footed, caught off sides, and get run over, which would be the cause of those really big moves. We tend to move really big when people are on the wrong side of the trade. Well, when you're hedged to the eyeballs, there's no such thing as the wrong trade. So we might not get a big move at all. Now, with all of this in mind, keep in mind that technical analysis in its most basic form is nothing more than looking at what's happened in the past and making a really informed decision about what's taking place right now or what could happen in the near future. That's the nutshell of technical analysis. And in that, trend lines, hammers, dojis, flags, cup and handles, head and shoulders, none of that stuff applies when a market is hit by an economic event and we start making moves. So, you know, your typical pivot points, yesterday's high, low, close, none of that stuff matters. The market will run right through anything in its path and it won't care. So it's not that I'm saying that technical analysis will be worthless. It won't be, it's not. But you set it aside in events. It's why trading penny stocks with technical analysis doesn't really jive that well, right? Penny stock trading is event trades, and events break technical analysis. So that's the spot we're at today. So now that we've gone through all that, we've got about 15 minutes before this data comes out. If it wasn't an event day and we just had this range here, you wanted to project some levels without all those labels and indicators and lines and drawings and tools that are all over the place. You just measure the range and give it 50% and 100% to the upside. This is basic technical analysis 101, right? If it wasn't an event day, this is what we would want to do with the range that we're looking at right here. It's what you do with ranges, right? You measure the range, you plot the projection upward and or downward if you're not sure which direction we're going to go. And now you've got your ranges. You can do that with an individual candle. You can do it with a timed area, like right here, I'm only using the Globex. You can do it with an entire day, like all of yesterday, all of the week, all of last week, things like that. So we're looking for the gap close play. At least that's what I'm looking for. It'll look like that. Now, it doesn't have to go up. A gap close play can go down or it can go up. I just didn't have any down examples in this. So 830, big data print. It might base across the top or across the bottom. I don't trade between 8:30 and 10 most of the time. So for me, I wait for it to get out of that window because there's plenty of time. I know where we're going, right? We're going back to the 8:30 print. So at whatever time it deems, that I'm ready to go, I come in and I get a trade. I've got the destination in mind, right? Somewhere in this move to the downside, I get my trade and I'm good. And that's all I'm looking for. I'm not trying to catch, top to bottom, running it all the way back down. Contrary to popular opinion, big, massive moves are not what I want to trade, and it's not what pays the bills. A solid 5-point trade with 10, 12, 15 contracts is way more valuable than some hopeful 50-point move with one contract that I have to hold on, 30 minutes, an hour, and deal with a bunch of pullbacks. And yeah, no. Nine minutes. I hope y'all have a good weekend. I'm always around if you have questions. This is just one trade, right? It's strategies. I have a lot of strategies. I like trading with strategies, and we have the opportunity today for this one. Have a good weekend. Be careful. Be safe. I will see you all next week.